What's your sense, based on what you heard, about the potential of regulation coming down the pipeline, and how would it impact your business?
So, based on the testimony yesterday, when you have all three regulators talking about additional regulation, I guess we would all expect to have some coming down the pike. We are well regulated as an institution. There's sensitivity to market risk. There's asset liability testing that they do on all banks, regardless of size, and we're no different than that. So, we expect it. I think we've do a great job managing our operation. I do think Silicon Valley Bank and Signature were unique situations, more probably failures of risk management than it was failures of regulation or failure of the regulators. So, like all things, the pendulum seems to swing, one way,
Right.
and we'll be prepared for it as an industry. But I do think there are plenty of regulations that we deal with every day in managing our businesses.
Yeah, interest rate management, a term that we've heard over and over again. I know we got to speak for a second. You didn't buy a lot of treasuries. That wasn't an issue for you. But I do want to talk to you about commercial lending. About half of your loans are in the commercial lending space. Just take a listen. We had a guest earlier today, UBS Wealth Management CIO Mark Haefele, and he had this to say earlier about commercial lending.
One of the things that we've been looking at is, the lending and will there be a reduction in lending? And I think it's important for people to realize banks that have less than 250 billion in assets are doing roughly 50% of the commercial and industrial lending in the US. And so we think that this at the margins could mean that credit contracts, and that increases the risk that we have a harder landing.
All right, Jeff, don't want to expect you to answer the question about the hard or soft landing. That's a tough one. But I do want to ask you about credit contracting. Based on what we're seeing, especially for your business, are you going to see any big changes in your philosophy when it comes to commercial lending?
So overall, we've always been a pretty conservative lender, and I know all bankers say that, but I think our credit statistics over the years have proven that out. What we are seeing, with the additional focus on liquidity, on capital, and while we have ample liquidity, we have over $2.4 billion of access to liquidity. We have very, very strong capital. I do believe that you will start to see things slow down a little bit as banks start to want to get priced for their risk. The cost of deposits has increased significantly, and with that, we need to increase the pricing on loans. And I think we are starting to see that is having an impact on customer demand with respect to projects that used to work at 6%, 5.5%. When you get to 7%, or prime's at 8%, all of a sudden they don't cash flow as well, and the borrowers are actually pulling back. In addition to bank appetite, as things are tightening up a little bit.
All right, I want to talk to you about your residential mortgage business. Not a big part of your business, but it's significant. The Philadelphia area that you serve, we're seeing a big influx of people moving into the area. Gentrification, in all fairness, a lot of turnover of homes. So how is what we're seeing when it comes to regulation, the potential for it, and the tightening of credit, how's it going to impact your residential mortgage business?
So overall, our residential mortgage business over the last 3 years has been very strong. We've done about $700 million in production. We are starting to see, though, that there is definitely a sensitivity to rate for the borrower. When we get to 6.25 on the 30-year fix, we'd start to see people lock. As rates tick up to 6.5%, 7%, we don't see the locks happening as much. When you combine that with overall demand, overall supply that's in the market, which the whole country is supply strained right now when it comes to homes, that definitely does have an impact, especially on the first-time home buyers. We're not seeing it as much on the larger deals. They still seem to be less price sensitive when it comes to rate, but definitely when it comes to the first-time home buyers, they're being squeezed out of the market based on the higher rates.
So Jeff, I want to ask you a question that we're going to be asking a lot of regional bank CEOs. A lot of talk about raising the limit for FDIC insurance above $250,000. Does that change your business at all? Do you think that would make customers more confident in leaving their money in your bank?
Honestly, I don't think it would have a huge impact on our bank. Our average consumer deposit's about $17,000. Our average commercial deposit's a little over $100,000. So raising it above $250,000 in reality doesn't have a huge impact, nor would it have a huge impact on most banks around the country who have a diversified model. As I said earlier, SVB and Signature were unique circumstances. Their balance sheets aren't really representative of the vast majority of regional banks throughout the country. So it really comes down to kind of what's your philosophy on what deposit insurance is for. I don't think it's necessarily to protect the $3 billion venture capital deposit that a bank might have. It's more focused on making sure, the mom and pop down the street, that their deposits are secure. So I wouldn't necessarily see a huge impact on our customer base. We send out communication to everybody when all of this went down, and frankly, our call volume was pretty small.